Hello students, today's class is on chapter 8 of your management accounting. So it comprises of divisional performance and you will be assessing the performance using these tools, and you will get a 7-mark question and sometimes a 7-mark theory question additionally from this topic. So let's begin.
So what is divisional performance? This is more of on the analysis side of management accounting. So far, whatever you learned, activity based costing, marginal costing, standard costing, budgetary control, all this you think that you are working in the organization as a cost accountant or a management accountant, and you are preparing this for the management. So this is more of an internal role you are playing. When it comes to the divisional performance, it can be internal, it can be an external role also. That means, let's say management asks, assess how are my divisions performing. So when the business grows, it is difficult to manage it as a small single unit. So what they will do, they'll divide it into, for example, geographically, they can divide into north-south division or east-west division. So that is geographical division. Then it can be manufacturing division, sales division. So functionally they can divide it. So this is basically all the management aspects. In this role, what you will do, you will analyze how's the performance of my company. You will not be computing, you will be doing some certain computation, but more than that, you will be analyzing how is my company going, or it can be for an external company also. So let's say you want to acquire a company. So you want to understand what is their performance. Are they really profitable? If we take over, then can we make good profit? So all these is covered in this divisional performance. So this is the introduction part. It has broadly 5 topics. One is Dupont analysis. Here you will assess what is the return of equity of the company. So we will go detail what is these returns. Then you have certain tools or certain formulas like ROI, return on investment, RI, ROE, ROCE. So all these are different way of computing the performance. Then you have EVA, which is short form for economic value added. And the learning curve, this can be not an analysis type of thing. This can be more of a computation. Then you have balance scorecard. So out of this, typically it is observed you get a question in EVA repeatedly asked. Learning curve, you can get an MCQ. So that is 7 plus 2, 9 marks. Then you can get a question which combines these two. So that is also possible. Then you can also get a question which combines this along with your marginal costing or standard costing. So all these are possible. So that's why when I say when you're learning accounting, they're all interlinked. It's very interesting when you combine one topic with the another. Okay, so first we will go to what is your Dupont analysis. So I've given some theory, but I will explain what it is. So this was actually conceptualized by a company called Dupont in the early 1920s. What they did, how do you assess a performance of the company? So there are various ways. How much profit they are generating. There is one. First is, are they generating profit? Then with respect to, let's say, sales, what is my profit? So that is your nothing but your sales margin. Similarly, my profit can be with respect to investment. Let's say I invested 1 lakh rupee in share market. I got 1000 rupees or 10,000 rupees. So with respect to my investment, how much income I have generated? So that's return on investment. Similarly, there is return on equity. So everywhere in the numerator, what you have? You have return. Only the numerator denominator is changing. That means with respect to what your return you are calculating. So one is your margin. So margin percentage. This is one way of assessing it. Second was return on investment. So everywhere in the numerator you have what is your return. Similarly, in ROE is nothing but return over equity. So what is return? That is a general term given for profit. But again, in profit, you have various way of computing return. It can be operating return or operating profit. It can be net profit. So generally they are called as profit after tax, profit before interest and tax, then EBITDA. All these are different forms of return only. So in this equation, what we consider net income. That means we have paid everything, all tax, interest, everything is given. And we compare that profit value with the shareholder equity. So that is return on equity. In Dupont analysis, what happens? This is broken down into different factors. So what are these factors? We will see. So it is given here, these factors. This is 1, this is 2, this is 3. And their explanation or elaboration is also given in the bottom formula. If you take this equation, no, in the bottom, you see this part, the equation part. So here operating income is in denominator. In the next factor, the operating income is in numerator. So when mathematically these two will cancel. Similarly, mathematically asset or investment also will cancel. So what will be left? You have net income and shareholder equity. These two are there. That is nothing but your return on equity. But in the Dupont analysis, I derive my return on equity using 3 factors. So first is net profit margin. This is nothing but your PAT divided by total sales. So this is your net profit margin. Then asset turnover. Asset turnover is how much sales I am doing with the given assets. So I have a lot of machinery, I have building, all these are my assets. Using them, how much sales I am able to generate. So this will be some multiplier. Let's say I have a building, factory building, which has a valuation of 1 crore. Then I have machinery, plant and machinery of 1.5 crore. Using this, I produce certain goods, then I sell. My total sales is 3 crore. So numerator it is 3 crore, denominator is 1.5 crore. That means I am able to generate 2 times of my asset. So that is my asset turnover. Then I have financial leverage. So whatever asset and investment I have, this is what proportion of my equity. So equity is basically the original contribution by the equity shareholders. So using that equity, when the business is conceptualized, I buy certain things. Then I also take loan. Then using that, I buy certain capital equipment. Then using all of this, I manufacture or I do trade. Then I generate income. So over time, this asset or investment is what portion of my shareholder equity. This is called as financial leverage. Okay. So the combination of these 3 is nothing but your return on equity. So the formula for each of them is given elaborated here. Net profit margin is nothing but net income, that is your PAT, over sales or revenue. So PAT is, you should be very conversant using what is PAT, what is PBIT. So PAT is your PBIT minus interest and tax. So you first get your operating margin, which is from the sales or revenue, you just subtract operating expenses. What are operating expenses? To operate what all you need, your material, your labor, utility, then overhead, all of these are operating expense. So you get operating margin first or operating profit. From that you will subtract depreciation. Then you will get EBIT. Then you subtract interest. So you will get EBT, earning before tax. So first you have, so this is your operating margin minus depreciation and amortization. You will get EBIT minus interest. Why I subtract interest? So my tax should not include this interest. So that is why interest is given first. So I will get EBT. That means earning before tax. From this I subtract tax. What I will get? I will get EAT or PAT, profit after tax. So when you do the proper analysis of your income statement, you will understand all of this. So from EBIT, I am subtracting interest and tax to arrive at PAT. So that is this point. Then asset turnover is by how many times my revenue is exceeding my asset value. Financial leverage is what is my total asset compared to my average shareholder equity. So in your syllabus, you also have 3-step Dupont analysis. Also you have 5-step Dupont analysis. So 5-step we will see later. It is again, it will be a combination of 5-factor instead of 3-factor. But finally they will all cancel out and you will be left with net income over shareholder equity because ROE is return over equity. So why is it required? So let's say there are two companies. So both have a ROE of 20%. How do you assess them? Which is better? So now we know ROE is a comparative tool. Both of them have 20%. In this case, I get confused. So in this case, Dupont comes into help. How? So PRDC is a acronym to remember. One is it identifies performance drivers. So instead of this 20%, so 3 performance drivers, which is your net profit margin, asset turnover and financial leverage. These are the performance driver. It identifies them and it segregates them. Then using this, you can do risk assessment. For example, degree of financial leverage. If it is too high for a company, then it is very risky business. So risk assessment can be done. So for D, it is decision making. So now I know out of this both 20%, which company has what strength, whether it is aligning with my style of working, then I can do the proper decision. So with all of this, we can do a comparative analysis. So PRDC. So what are the benefits? Now I am not only looking at one single number, but I have comprehensive financial insight. How the management is running the company, how is the profit margin, how are they utilizing the assets, and how are they running the company at what level of financial leverage. So who are the users of this? I told you, this is more of an external role you will have. Investors. So investors, if they want to invest in a company, they would want to understand the performance of the company. So my company wants to invest in another company. Then also this will come. So investors. Then financial analysts. So big fund houses or big traders, they want to understand in depth. Then corporate managers. That means the management. Lenders and credit analysts. So banks. So they want to see what is your leverage. So they will be interested in that factor. Then business valuators. Let's say I am selling my company. So using this, they will get a better idea of what are my strengths. So accordingly, it will be valued. Let's take an example. Okay. This is a real life example. So this is the data of Reliance Industry in 2020. So they have a net profit margin of 10%. That means I am investing 100 rupee. I am getting 110 rupee. So 10 rupee is my profit. So that is the meaning of net profit margin. Then asset turnover is 1.1. Financial leverage is 2.1. So when I apply Dupont, I will get 23.1%. Otherwise, I directly calculate ROE also, I'll get this. So using this, 10% is okay. It is at least beating FD returns after providing for all other expenses. Then asset turnover is 1.1. Okay, I have a asset of 100 crore. I am generating 110 crore. So this is also a good number. Then financial leverage. So this is not too high. If it is around 1, it is good. Okay, this is also okay. So using this, I get a ROE of 23.1%. So another tool, we will solve some more problem of Dupont, a combination of Dupont and ROI going forward. So next tool to assess the performance is return on investment and residual income. Simply, what is ROI? On my investment, how much am I getting? So let's say I'm investing in a property or I'm investing in shares. with respect to that, how much I am getting. So here I am not deducting my interest or tax. In ROI, it's operating profit. So EBIT over total capital employed. What is total capital employed? It is nothing but my total assets minus current liability. So that is one way to put it. Or it can be all my fixed capital plus my working capital. So that is also the total capital employed. In simple understanding, I am investing something. How much am I getting? Barring all my operating expenses. So this is my ROI. Then what is RI? Residual income. So the formula for residual income is EBIT minus minimum required rate of return into operating assets. So let's break down this formula. Residual income is, in simple terms, I have certain expectation. I am investing 100 crore. I have certain expectation. So let's say it is about 5 crore is my expectation. So over and above 5 crore, how much I am earning? So that is my residual income. So this 5 crore turns out to be about 5%. So this is just a random figure I wrote. But what happens in companies, they have minimum required rate of return. Why it is there? Suppose I have 100 crore cash with me. What I can do, I can buy certain bonds and I will get some returns. Or I can put it into share market, I will get some returns. Or I'll put it in deposits, fixed deposits, there will be certain return. But I can also manufacture something, market it, invest in R&D, then sell that. I will get certain return. It may be higher. So for taking that risk, I'm getting more reward. So how much I am getting over my minimum required return? So that is my residual income. So let's say with an example, if a business has operating income or operating profit of 50 lakh, how is it generating 50 lakh of operating profit? It has operating assets of worth 2.5 crore and minimum required rate is 12%. So my desired income is nothing but 2.5 lakh into 12%, which is 30 lakh. And how much I am actually getting? EBIT. So this is my EBIT. I am getting 50 lakh. So that means I have a residual income of 20 lakh. I am generating 20 lakh more than my expectation. So what is the use of it? If I am generating a positive value, even 1 rupee positive, means I am creating more value over the minimum requirement. Negative residual income means I would have simply kept that in my FD without doing any business and I would have made money. So by doing business, I actually lost value. So that is the meaning of my negative residual income. So when the business want to expand or they want to shut down, they will see this residual income, whether I am making any real profit using my assets, whether do I have a positive RI or I have a negative RI. If I am negative RI, I should disinvest. This is not working out. I should try something else. So that is what the companies do when they assess their performance. So you learned ROE, then RI, ROI, then there is also ROCE, means ROCE, return over capital employed. So these are all different ratios which investors use, which banks use to assess the financial performance of an organization. This also comes in your financial management and strategic financial management. There are a lot of ratios. So there you will learn this. So whether you learn it there or here, it is the same equation. I am explaining the logic on certain tools only. In financial management, you have a detailed ratios. So now we will solve this one problem. Okay, this is from one of the previous question paper only. So Sandeep Corporation has 3 divisions whose income statement and balance sheets are summarized below. So in the table below, you have sales, operating income, then you have operating asset, asset turnover, margin, ROI. So some places values are given, some places some numericals are given. So they are asking supply the missing values through 1 to 7 in the table above, 7 marks. That means for each missing information you will get 1 mark. So what is first thing they are asking? Asset turnover of 1. So we will start with X. So what is the asset turnover, meaning of asset turnover? So how to understand it? I have a building, I have a plant of some value, that is my asset. Using that, how much sales I am generating. So that means it is sales divided by my assets. So this is the formula for asset turnover. Now in this equation you have to check whether sales are given. Yes, sales are given. For X it is 10 lakh. Okay. So this is 10 lakh. And assets, are they given? Operating assets, they are given, which is 2 lakh. So I will write divided by 2 lakh is equal to, I will get a number. So asset turnover is always a number. It's a ratio. So 5 or 500%. So now I have found out this. So this is 5. Next missing information is margin. So margin is easy to calculate. But here they are asking margin as a percentage. Why? You look at values of Y and Z. You have percentage. So what is the margin? In your Dupont, you have first factor, which is your net profit margin. In the margin, numerator is your operating income or net income actually. But in the equation, it is net income or PAT. In this question, net income is not given. Only operating income is given. So I will take only operating income. So operating income divided by sales. So what is my operating income? 50,000. What is my sales? 10 lakh. So this will give me a percentage of 5%. So 2 mark. Then ROI. Third one is ROI. Return on investment. So what is my return? Return is my net income. But in the ROI formula, it is EBIT divided by my investment. Here I do not have, okay, here I have a operating income only, which is EBIT. So operating income divided by cost of investment. Whether my cost of investment is given anywhere here. My cost of investment is not given, but my operating asset is given. So I will take asset only. So my operating income in this case is 50,000. Then my asset is 2 lakh. This will give me an ROI of 25%. There is another formula for return on investment. Okay. So this also you learn. ROI is also given by another formula, which is your margin into asset turnover. This also gives you ROI. So here my margin is 5% and my asset turnover is 5. So I will get 25%. So both are same. So my ROI is 25%. So 3 calculated. Now I'll get 3 mark. Fourth one I have to find out sales. How to find out sales? Which equation you have to use? Now we will see. Also you have to find out operating asset. Also you have to find out asset turnover. But margin is given. So let's say I have information of operating income and margin. What can I calculate? Margin is equal to operating income by sales. In this, margin is given, operating income data is given. That means I can calculate sales. So sales is equal to operating income divided by margin. So Y sales is equal to operating income divided by my margin. What is operating income? 60,000. What is margin? 0.5%. So I'll write 5.5% only. So 0.5% is 0.0005. So calculate and tell me how much you will get. So 1 crore 20 lakh is my sales. So this is done. This is 1.2 crore. Next I have to calculate my operating asset. So asset turnover, whether it is given, no. Asset turnover is also not given. Then which formula I have to use? So margin I have used. Using margin and ROI, I can calculate asset turnover. This is the formula. Where is the formula? This formula, I can use margin and ROI to calculate my asset turnover. So asset turnover is equal to ROI divided by margin. Asset turnover is equal to ROI by margin. What is my ROI here? 2.5%. Margin is 0.5%. So 2.5% divided by 0.5%, I will get 500. So this is also in percentage, or I can write it as 5, means 5 times. So I have got my asset turnover, which is 5. Then operating asset, I can use asset turnover formula directly. So my asset turnover is sales over asset. So I have to find out asset. That means sales divided by asset turnover. So assets is equal to sales by asset turnover. So both the values we have calculated here. 1 crore 20 lakh divided by 5. So 24 lakh is my asset value. So you have calculated 6. So 6 marks you will get. Now last one, you have to calculate sales. You can calculate using any of the formula. You can use the margin formula. So margin is equal to income over sales. So sales is equal to income over margin. So this is income over margin. 10,000 divided by 0.04. 4% is 0.04. So you will get 2,50,000. Sales is equal to 2,50,000. It's a very simple question. It will not take much time also. You just have to remember certain formulas. Second problem we will take. So the following information relates to operating performance of 2 divisions of SAIL for last year. What are the information given? So you have Bokaro division and you have Durgapur division. You have operating profit. It is EBIT. Then you have total assets. Total assets, 2 value given. One is acquisition cost, current replacement cost. Then they are asking compute the return on investment of each division using total asset stated at acquisition cost as the investment base. Second is compute ROI of each division using total asset based on current replacement cost as the investment base. Then which of the 2 measures do you think gives the better indicator of operating performance? So what is the formula for ROI? EBIT divided by cost of investment. So this is your formula. So let us take the case of A, where cost of investment is the cost of acquisition. So you have Durgapur, or you have Bokaro first, then you have Durgapur. Then A is acquisition cost as base. So ROI is equal to EBIT over cost of investment. So for Bokaro, what is EBIT? 8 lakh. And acquisition asset cost is 40 lakh. So this will be 8 over 40, which is equal to 20%. Then you have 12 over 75. So you have 12 over 75, which is equal to 16%. Similarly, B, replacement cost as base. Now numerator will not change, only denominator will change. Numerator remains 8 lakh and 12 lakh, but denominator changes to 60 and 80 lakh. So 8 over 60, then 8 over 12 over 80. So I get 13.33% and 15%. So this is my basic calculation. Now third question they are asking, which of the 2 measure do you think gives the better indicator of operating performance? So here you have to use certain logic. So I have invested 100 rupee. I have generated 10 rupee. So my ROI is 10%. But when company is doing it, they also do depreciation. So the carrying value comes down. Or they have acquired these assets maybe 10 years back. Then the cost of equipment was less. And now I am generating 10 rupee using the 10-year-old machinery. So that means my base, whatever denominator, is lower. If today I want to perform using the same machinery, same asset or same investment, how much will be that ratio? So today that same machinery will cost me 200 rupee. So instead of 10 divided by 100, now it will be 10 divided by 200, because I am not assessing my return. I am assessing what? Operating performance. So for operating performance, today if I invest 200 rupee, out of the 200 rupee, how much I am getting, how much am I generating? So it's kind of a qualitative answer. So you have to tell, you have to use replacement cost as base.
The next important topic in the divisional performance is called as economic value added, or in short, it is called as EVA. You can expect a 7-mark question from this chapter.
So to calculate economic value added, in short EVA, you have to remember this formula. EVA is equal to NOPAT minus capital employed into weighted average cost of capital. NOPAT is net operating profit after tax. This is nothing but EBIT into 1 minus tax. Then capital employed is nothing but all the long term capital which is employed in the business, which is equity, debt, or any long term leasing. So all of these are coming under capital employed. Weighted average cost of capital is nothing but the average return required by the debt and the equity shareholders. So to simplify this, we will take an example and try to solve. So I will pause here, read the questions, identify the factors, then we will continue. Now, total capital employed. This is nothing but your CE, 45 lakh. Debt equity ratio 1:4. What is the meaning of this? Means debt in the proportion of 1 and equity is in the proportion of 4. So total is equal to 5. So the meaning is, in the capital employed 45 lakh, 1 by 5 is debt and 4 by 5 is equity. So 45 lakh means debt is equal to 45 into 1 by 5, which is equal to 9 lakh, and equity is the balance, which is 36 lakh. Interest rate of debt, this is nothing but your KD. So we will come to what is that KD. This is cost of debt. Effective income tax rate is 31.2%. This is T. Risk-free rate of return, so in the formula it is KF. Long-term market rate of return, also called as KM. Then degree of financial leverage 1.1 times and the beta factor is 1.4. Using this, you have to calculate your EVA. So first we will write EVA formula. EVA is equal to NOPAT minus capital employed into weighted average cost of capital. NOPAT is nothing but EBIT into 1 minus tax. So in this question, you have tax which is 31.2%. This information is given, but no information about EBIT is given. That means EBIT you have to calculate indirectly using this information, which is degree of financial leverage. What is this formula? You should remember this formula. Degree of financial leverage is equal to EBIT divided by EBIT minus interest expense. So in this question, DFL is 1.1. EBIT you have to calculate. What is interest? Interest rate of debt is 12% given and debt is 9 lakh which we calculated. So 9 lakh into 12%. So that is your interest expense. So interest is equal to 9 lakh into 12%, which is equal to 1 lakh 8,000. Now we will put everything in the equation. 1.1 is equal to E divided by E minus 1,08,000. So when you solve this, 1.1 E minus 1188 is equal to E. So therefore E is equal to 11,80,000. So this we will substitute in the NOPAT equation. 11,88,000 into 1 minus 30%, 1 minus 31.2%. So this we can write it directly as 0.312. So therefore your NOPAT is equal to, therefore NOPAT is equal to 8,17,344. So let us call this as 1, which is the first part in your EVA equation. Next we have to calculate the second part of your EVA equation. Cost of, this is called as cost of capital employed. 2 is cost of capital employed. So what is the capital employed? For capital employed, the information is directly given. Sometimes it will be given, sometimes you will have to calculate. So 45 lakh is the cost. So second part, capital employed is 45 lakh. Then weighted average cost of capital. How to calculate this? This is equity and debt in their percentage. You have to add, and debt you have to multiply with 1 minus tax rate, because on the interest there is no tax applied. So KE, again in this problem statement, KE is not given, KD is given, which is 12%. So KE you have to calculate using the formula of CA-CMA, which is KF plus beta into KM minus KF. So KF is risk-free rate. Suppose this capital I am employing in a risk-free instrument like government treasury bill. What is the percentage I am getting? That is your KF. KM is the average market return. Let's say I am investing this in Nifty. So market on an average, what is the rate it is returning? That is your KM. And beta is the volatility factor. So now we will substitute the information given for KF, KM and beta. KF, it is given 10%, KM 15% and beta is 1.4. So when you solve this, you will get 17% as your cost of equity. And KD is cost of debt. How to understand what is KD? You have to look in the question, and is there anything on bond or debenture or any loan, and what percentage they are asking. So in this question, interest rate of debt 12%, that is your KD. So KD is 12%. Now we have KE and KD. Now we can calculate weighted average cost of capital. So WACC is equal to 17%, and the proportion we will write it, plus 12%, we will write the proportion, into 1 minus tax. So 1 minus 0.312, which is 31.2%. So the debt equity ratio is given. So we know debt is 1 by 5 and equity is 4 by 5. So we will write that in the proportion. This will give us 13.6% plus 1.651%. When you take this total, this is 15.25%. So I have got my WACC. I know my capital employed. So cost of capital employed, which is the second factor, is equal to 45 lakh into 15.25%. This will give me a value of 6,86,250. Now I have calculated 1 and 2. EVA is equal to NOPAT, which is 1, minus cost of capital employed, which is 2. So 8,17,344 minus 6,86,250. This will give me a positive value of 1,31,094. If the value is positive, that means it is adding value. If this value is negative, means the value is getting destroyed. So 3 steps. You have to first calculate your net operating profit after tax. For that, you will require your EBIT details. EBIT can be calculated using your income statement or degree of financial leverage. If that is not given, you have to use this formula, DFN. Second is weighted average cost of capital. You have to calculate using the debt and equity and their proportions. So let us see more information in the next problem. So here we have a different type of EVA problem, the same formula, but the information given are different. The cost sheet of Aptamil Limited for the year is under. So here you have to notice that the cost per unit is given. Here we are not solving the cost sheet problem. We are solving for EVA. That means we need net operating profit. So all direct material expense, everything is given. Then what we need is actually the cost of sales per unit, which is 20. So per unit it is 20. The company sold 5 lakh units of its product during 23-24 at a margin of 15% of cost. So with this, we can calculate what is total cost, and 15% of cost is the profit. So 20 into 5 lakh, I will get. So 20 into 5 lakh, I will get the total cost. So total COS is 5 lakh units into 20 per unit. This is a value of 1 crore. And what is my margin? It is 15%. So profit is equal to 15% of COS is equal to 15 lakh. This is also net operating profit, which is my EBIT. Now I have to adjust for the tax. I will get NOPAT. So NOPAT is equal to EBIT minus 1 minus tax. So we will see in the question whether the tax rate is given. Effective tax rate applicable to the company is 30%. So using this, we can calculate 15 lakh into 1 minus 0.3. This is equal to 10 lakh 50,000. So this is the first factor in our EVA formula. Now we have to calculate the second factor, which is the cost of capital employed. Let us continue. On 1/7/2023, the company sold an asset of 250 lakh, 2.5 lakh to this limited. The cost and accumulated depreciation are so and so. So we don't need any depreciation related information when we are calculating EVA because it is operating profit. So we can ignore this. The market capitalization of the company comprises of the following: 12% bond, equity share capital, reserves and surplus. Values are given here. So typically you have to identify, you should be capable of identifying whether this is debt or equity. Anything that is like loan, that is debt. So bond, debenture, all of these are debt. So 12% bond is debt. Then equity share capital is equity. Reserves and surplus belongs to equity shareholders. So it is part of equity. Now debt and equity we have identified. Debt equity ratio you have to derive from this. So debt is 10 lakh, equity is 8 lakh. So debt equity is 10:8. So total is 18. Therefore debt is equal to 10/18 and equity is equal to 8/18. This we require when we are calculating weighted average cost of capital. Additional information: risk-free rate 10% is KF, Nifty return is market rate KM, then effective tax rate we have used, beta factor is 0.9. So this is beta. Using this, calculate EVA. So in the second part, first we will calculate cost of equity, which is KF plus beta into KM minus KF. Here KF is 10%, KM is 15%, beta is 0.9. So we will get cost of equity is equal to 14.5%. Then KD is equal to 12%. Why 12%? It's a 12% bond. That means we have to pay 12% of 10 lakh to bondholders. So KD is 12%. Now we can calculate weighted average cost of capital, KE into percentage plus KD into respective percentage 1 minus tax. So KE is 14.5. Then what percentage? We will see KD is 12 percentage and 1 minus 0.3. So debt equity ratio we calculated. Debt is 10 by 18, equity is 8 by 18. So 8 by 18, 10 by 18. When you solve this, you will get weighted average cost of 11.1111 percentage. So your cost of capital employed is capital employed into WACC. Capital employed is 18 lakh in this case into 11.11 percentage. This you will get as 1,99,980. So this is the second part of your EVA equation. Therefore, EVA is equal to 1 minus 2, where 1 is 10,50,000 and 2 is 1,99,980. So with this, you will get an economic value added of 8,50,020. So this is your EVA. Hope this was clear. If you have got any questions, put it in the comment section below. Thanks for watching.